Hey y'all, and welcome back to Getting Digital with Deja. Alrighty y'all, so if you're new to my channel, this entire week I've been talking about how to trade with small accounts, meaning you have somewhere between $100 and $500. And today wraps up this whole series, and we're going to be talking about how to trade earnings reports, which means stock options. But you guys, before I get to that, can we just acknowledge something really quick? Your girl has made it to over 100 subscribers. I have 108 subscribers, you guys. I woke up to 104, you guys, and then by the end of the day, I was at 108. My channel is growing so fast, and I literally could not do that without you guys. So I really just wanted to take the time to tell you guys thank you. I don't know why I'm still talking with this pen. I just get overly excited because my channel is growing so fast, and I know 100 subscribers might not seem like a lot, but baby, it is a lot to me. I'm just a girl talking about finances. Who am I? I'm Deja. That's who I am. Okay, I'm just kidding. No, but I'm really for real. But anyways, let's go ahead and jump into this. Okay, guys, so let's hop into it. So I have told you guys before about trading earnings reports, and I thought it would be really profitable. And I've actually gotten lucky a few times with trading earnings reports. But I will say, after doing more research and getting pretty unlucky in the market a few more times, I would say that you should not be trading earnings reports, especially not as an early trader, not as a beginner. Your beginner's luck will run out, and that's not me being negative. That's me being straight up. And if you're like me, you're gonna learn from your mistakes. You're gonna take in the information that I say, but you're probably still gonna trade an earnings report anyways, and that's perfectly fine. Learn from your mistakes. Also try to learn from mine. Hey, that's why I'm here. But whatever, But the reason why I say not to trade earnings reports is because of the implied volatility. So let me tell you what that is. So let's get into the exact definition of implied volatility. You know your girl comes with the notes, so I'm about to read it word for word. It represents the market expectations of how much the price of an asset or stock will fluctuate in the future. Unlike historical volatility, which measures past price movements, implied volatility is forward-looking and is derived from the price of options contracts themselves. So you guys know that I really like using textbook definitions for these kind of stuff because it's easier to understand, and it's a way to where I don't get my words jumbled up because I talk really super fast, and sometimes people don't really get what I'm saying, but that's besides the point. So when there's high implied volatility, that just means that the market thinks that it's going to fluctuate by a lot. There's either a lot of uncertainty in the market, or it could also mean that they think it's really going to go in this specific direction. So that actually makes the premium price go even higher because they're including in the premium price based on the volatility that they think the direction is going to go, if that makes sense. So if they think a stock is really going to surge after an earnings report or something like that, they're going to include that in your premium price that you pay. And remember, your premium eats at your profits. Okay, so you have to always remember. So your premium is not just a number that you pay to get inside of a trade. No, you have to remember that that's actually money that you're kind of at a loss at if your trade doesn't follow through the way you want it to, or even if it does follow through the way you want to, you still paid a high premium just to get into it. So the reason why the premium price goes up is because traders in the platforms basically see that you're gonna probably be profitable off of this trade. So in order to get in this trade, you're gonna need to pay some money. You're not gonna pay for something that you don't believe in, right? Some people do, but let's be for real, we're traders. We're not about to be paying for stuff that we don't believe in. So high volatility just kind of equals high speculation and high just movements and fluctuations in the market, expected fluctuations in the market, okay? But let me tell you what happens after an earnings report is released. So an earnings report is usually always released after the closing time of the market. So, in Texas, it closed around 3 o'clock. So the earnings release is going to be after 3 o'clock. So the big money and big institutions and everything are going to see that earnings release, and they're going to be able to trade before us regular retail traders are able to trade. And because they are able to trade when the market is closed. So that just means that they're going to set the stage for the market, and there's nothing that you can do about it. When you wake up in the morning, your trade can just be like going in the direction that you want, or it can be going in the opposite direction that you want. And the thing about it is, nobody knows the information that's going to be reported in these earnings reports until they're reported. And earnings reports are not just about how much the company made in revenue. No, that's just one part of it. It's about their customer service. It's about their supplies, their demand. It's about how much money it takes to make their product. How many consumers are there consuming their products? There's so many different parts that goes into earnings reports, and every part is significant. So a company could be doing really good in revenue but being shitty in all the rest of the categories, and that's going to be bad for your trade, and that's another thing too. You have to understand, earnings reports can go this way or they can go that way. So there's so much uncertainty around earnings reports, which is why the market has such high volatility, because high implied volatility means a lot of uncertainty and a lot of fluctuations in the market. You get my gist? You get what I'm going? Okay, so let me tell you how you can really lose money on trading earnings reports. Is one, if the earnings report falls less of expectations. So there's this guy that does like Zach Investments, and there are these other people in the market who are like highly advanced traders and like advisors, and they basically submit a report saying where they think the market is going to go. A lot of people listen to it, a lot of people place their trades based upon it and things like that. So they have these estimates, and when the earnings reports come out and it falls short of those estimates, that is not good. I mean, because it creates like doubt in the market, okay? That's one way you can lose money, because your trade will go in the opposite direction. Boop. And the second way that you can lose money trading earnings reports is the implied volatility going down. So remember, high implied volatility means there's a lot of uncertainty in the market and there's a lot of expected price fluctuations. But once that earnings report comes out, it becomes low implied volatility, which means there's not really a lot of uncertainty coming out. The earnings release came out with all the data that everybody needs, so they know exactly which way the market is going to go and which way this company is going to go. So there's no more uncertainty and there's no more speculation. It's kind of like written in stone already, and that lowers the implied volatility, which is really, really bad for your premium, because remember, you make money off of your premium. So let's say you bought it and you paid $4 for the premium to, for a call option, right? But if the price of the stock goes down, the price of that premium will also go down. So when you go sell that call option, you're getting paid out the price of the current premium. So if the current premium is at $2, you just kind of like double paid a premium. Does that make sense? I know I worded that super weird, but like, if your premium goes up, that's good for you. That's wonderful for you, right? Because that's more money that you get paid if you have a call option, right? But if the premium goes down, that's bad, because that's less money that's going into your pockets, and you paid more to get into a trade that's actually making you less money when you finally sell the call option. So the third way you can lose money is, even if your stock goes into the direction that you want it to go into, with that low implied volatility, that's going to bring down your Vega. And so now let's get into the Greeks. So Vega is essentially just a measure in a stock sensitivity to changes in implied volatility. Textbook real quick. It quantifies how much the price of an option is expected to change for every 1% change in the implied volatility of the asset or of the stock. So positive Vega means that the price of a stock's option is expected to increase as the implied volatility increases, and it's expected to decrease as implied volatility decreases as well. And a negative Vega means literally the complete opposite. So it means an option's price is expected to decrease as implied volatility goes up, and increase as implied volatility goes down. So before you even place a trade, this information is readily available to you through your platform, and usually it's there right before you go to execute your trade. Like before you press the buy or the sell option, you can like scroll down and it'll tell you your delta, your theta, your gamma, your Vega, there's like two more, but I'm gonna be doing a whole video about that, so just like hold your horses, my guy or my girl, non-binary. So if I still haven't convinced you to not trade earnings reports, and you still are going to because you've been getting lucky doing it so far, much like I did, I will say you need to pay attention to that Vega number. That is super, super important, because there are some traders, some really experienced traders out there who trade literally just implied volatility. So volatility traders, essentially what they do is they buy in options when volatility is low, and then they sell it when volatility is high. And so you're buying buying it low, probably like well before earnings reports release, and you're selling it right before earnings reports release, and that's how you make your money. But the way I wouldn't trade that personally, because yeah, you can make some good money, but just think about if the earnings report goes like super in your favor. Like the earnings report just has amazing results, it beats all expectations and everything like that, and it soars through the roof. You just sold your option right before it boomed and before it soared. So you just really just missed out on profit. So it's just like, I wouldn't necessarily trade that either. But then on the safer side, it's like if the earnings report doesn't go as the market expected it to, you like literally saved yourself from losses. So that's why I say trading is so risky. You just really have to see what works for you and like listen to your intuition and your first mind. Like, I can't stress that enough. Listen to your intuition. There's so many trades I should have got into that I didn't get into because I didn't listen to my intuition because I was scared. And there's so many that I should have gotten out of that I told myself to get out of, but I was trying to be greedy. And so it's just like, the more you trade, the more you see, okay, I need to listen to my inner voice. Like, my inner voice is right, is always right. So that is all I have for you guys today, and that wraps up on how to trade with small accounts, this topic for the week. Yay! And I'm not sure what the topic for next week will be, but you know, we got a whole weekend to figure it out. So I just want to tell you guys and remind you guys that pretty girls can do trading too. All right, I will see you guys Monday with a whole new topic, so stay prepared and stay ready. All right, bye guys.